Okay, so this is part 2 of the correct chapter 18. As I said, I sent the chapter 18 from 545 to 502 by mistake. So this is the correct chapter 18. All right, so we're up to slide 62, and this is the third method to calculate valuation, and this is called the flow to equity method. And the flow to equity method is a valuation method that calculates the free cash flow available to equity holders, taking into account all payments to and from debt holders. All right, so the cash flows to equity holders are then discounted using the equity cost of capital. All right, so this is the third method. All right, so free cash flow to equity is it's the cash that remains after all interest payments, debt, and debt repayments are all done. Whatever's lingering around, whatever cash is left. All right, so we got to, the first thing they do is determine the free cash flow to equity. And here is, again, here is an income statement, right? Abbreviated right up to line 10. Everyone see this right here? So here's the income statement right up to line 10. Everyone should notice that. And here's the net income. Now this takes into account, here they're including the interest. You see that? So this is not unlevered. This is levered net income, okay? So here's the depreciation getting put back on. Everyone see that? Here the depreciation comes off. Here the depreciation goes back on. Here's your capital expenditures. Okay? Here's the borrowing. Here's the money you're borrowing because it's for the debt equity ratio, right? Here's the borrowing, right? So here's your free cash flow to equity. All right, so it comes out to 6.37, right? Here's your net income. Here's your capital expenditures. These are negative. Here's the money you borrowed, so you're left with this amount of money. Subtract these off of that. Again, here is, now this is negative. Here's your, all right, here's the money coming in. Here's the money, net borrowing going out. In all these cases, the net borrowing is going out, right? So these are positive, this is positive, and this is negative. So basically, you've got free cash flow here. And for the rest of these, all the net borrowing here is negative, right? So here's your free cash flow to equity. So once we got that, there's another way of calculating this free cash flow to equity. It's simply the free cash flow minus 1 minus the corporate tax rate times your interest payments plus your net borrowing after tax. And this is your after-tax interest expense. What this is really is, if you look at the table, this is the equation. This is what's happening in the table in equation form. That's all happening right down here, okay? So that's all going on right down here. So they're just taking these numbers and basically making an equation out of it. So here was the free cash flows, right? And this was what was given, right? Early on in the example. Here was your free cash flows. Here's your after-tax expenses. Here's the taxes coming off. And here's your net borrowing. So again, here's your free cash flow to equity. And all of these come out the same way because you only have one standard income and a statement, all right? So you can see it all comes out the same way. So once we have the free cash flows to equity, right, we now go and we look at all these up here. And here is the equity cost of capital, right? Because we're doing equity now. Let me, hold on, whoops. We're doing equity. So let me do that. So here's the free cash flows to equity. And you can see they go up here. Now we're using the equity cost of capital because we're doing equity, right? So the free cash flow to equity is simply this equation, and it comes out to, again, 41.73 million. Same as we had before, right? So again, it was identical to the net present value we calculated before. So all three methods, again, by the law of one price, all three methods have to come out the same way, right? So this is identical to the numbers we got with the weighted average cost of capital and the adjusted present value, right? So this is an important slide that everything's got to work out the same way. So here's the summary of the third method, the flow to equity method. So we determine the free cash flow to equity of the investment, determine the equity cost of capital, and then we compute the equity value by discounting the free cash flow to equity using the equity cost of capital. All right, and here's the advantages and disadvantages of this method. So they've got some advantages to it, and they've got some disadvantages. All right, so we got advantages, and we've got some disadvantages here, and they list them all. And here's now another textbook example from the textbook, and they use the FTE method to value an acquisition, and they give you all these numbers here, right? And they want to know what is the value of this acquisition using the free cash flow to equity method. Because the acquisition is being financed with $50 million in new debt, the remaining $30 million of the acquisition cost must come from equity. So we kind of know that by now, right? In 1 year, the interest on the debt will be $3 million. Because Avco maintains a constant debt-equity ratio, the debt associated with the acquisition is also expected to grow at a 3% rate. So the debt's going to grow at $51.5 million. Therefore, Avco will produce an additional $1.5 million in 1 year. So the free cash flow to equity now, again, is $4.25 million, right? Minus 1.025 times 3 plus this extra 1.5 million. Okay. So these are the free cash flows, right? Forever. And you end up with basically 3.5 million for that 1 year. And after year one, they grow at 3%. So using the cost of equity at 10%, the net present value comes out to 20 million. So this matches the result we obtained with the weighted average cost of capital, and again the adjusted present value methods. So you can see they all have to work out the same by the law of one price. They all have to come out the same. All right, so there's another one, a very similar example that they gave you here. Okay. All right, so basically, if you look at project-based cost of capital, they could have different risk than the average project for the firm, right? So now they're looking at specific projects and the risk level associated with that. All right, so before we go into project-based costs of capital, I want to attach two videos for adjusted present value and free cash flow to equity video to this one, and because it's going to get kind of big, and then we'll do a part 3 with picking up from slide 78, project-based cost of capital.
In this and the next video, we are going to compare WACC with adjusted present value. As we know, WACC is by far the most popular method to compute the discount rate when doing a firm valuation. In previous videos, we discussed several characteristics of WACC. In this opportunity, we are going to focus on the limitations of WACC, given the assumptions of the model. Then we will introduce adjusted present value as an alternative method. There are a number of assumptions in WACC which are relevant for the discussion that we are going to have today. There are other assumptions, but the ones which are relevant are these ones that are pointed out here. First, WACC assumes that all cash flows are perpetuities. Second, that there is a unique and constant corporate tax rate. And third, that there is a constant leverage ratio. In principle, when these assumptions do not hold, WACC could not be used as a discount rate. Practitioners usually get around these limitations, at least partially, by recalculating WACC according to every period's leverage ratio. Also, when there are other tax effects related to the debt, different from just the simple corporate tax rate, then also you can incorporate other tax effects by calculating kind of an average tax rate. These are the ways in which practitioners usually get around the limitations, at least partially, the limitations of WACC. Although this is an improvement, however, this approach is only an approximation, since WACC ends up being adjusted only at the end of each period, usually a year. And actually, the changes take place throughout the year. So rigorously, WACC would have to be adjusted much more frequently in order to alleviate these limitations in a significant way. Let's introduce adjusted present value. The adjusted present value formula is the one we see here. The value of the levered firm is equal to the value of the unlevered firm plus the present value of the tax shield minus the present value of the cost of financial distress. So when we want to compute the value of the levered firm, we first compute the value of the firm assuming that the firm does not have any debt. And then apart, we calculate the present value of the tax shield, and apart, we calculate the present value of the cost of financial distress. And then we add them up together to get the value of the levered firm. Under the adjusted present value formula, the tax shield materializes through a cash flow increase, and also the cost of financial distress. You see that the tax shield is considered a cash flow, and also the cost of financial distress, and then we calculate the present value of each of them. This contrasts with the practical WACC, in which both these effects, the tax shield and the cost of financial distress, are incorporated into the discount rate. So they are not considered cash flow effects. They are just we just modify the discount rate in order to account for these two elements. However, the problem with adjusted present value is that the cost of financial distress are quite difficult to estimate as a cash flow. We would have to do some kind of Monte Carlo simulation or a similar method. Professor Damodaran from New York University proposes a very simple approach to calculate the cost of financial distress in the case of adjusted present value. The expected present value of the cost of financial distress is assumed to be the probability of bankruptcy multiplied by the present value of bankruptcy costs. The present value of bankruptcy costs are estimated to be between about 5% of the value of the unlevered firm for the direct cost of financial distress, and between 25 and 30% for the indirect cost of financial distress. So we calculate the present value of the unlevered free cash flows to get the value of the unlevered firm. Then we multiply that for 25, 30%, up to 35% in order to get the expected present value of bankruptcy costs. And if we want to calculate the final effect of bankruptcy cost on the value of the firm, we have to multiply by the probability of default. And how we get the probability of default? Well, we can get it from the rating of the debt of the firm. So if the firm's debt is rated, we know that there is a table, this table, that tells us what is the probability of default according to each rating level. So we already have all the elements we need to calculate the expected bankruptcy cost in terms of present value. First, we estimate the value of the unlevered firm. Second, we multiply that by 25 or 30% to account for the cost of financial distress. And then we multiply by the probability of default, depending on the rating of the debt of the firm, to get the expected present value of bankruptcy costs. APB characteristics. Well, the interesting thing about APB is that given that we use the discount rate for the unlevered firm, rho, and this discount rate for the unlevered firm, of course, does not depend on the level of debt and does not depend on the profile of the cash flows. So whatever the shape of the cash flows, whatever the profile of the cash flow, so during the horizon, rho will stay unchanged. So we don't need to assume that the cash flows are, for instance, perpetuities, as we assume when we use WACC. The other element is that given that we treat leverage apart from the value of the firm, we just calculate the present value of the tax shield as in a different worksheet. Okay, we just estimate the tax shield and we discount the tax shield to present value, so we treat it separately. Then, of course, we don't need to assume a fixed debt ratio as it is assumed in the WACC method. And finally, also given that the tax shield is calculated apart, then we can estimate the tax effects according to the particular legislation of the case we are analyzing. We don't have necessarily to assume a constant and fixed corporate tax rate as we have to when we use the WACC rule. We just estimate the tax savings according to the particular tax legislation. So there is a much more flexibility in the case of APB. So we can see that the APB method is promising as an alternative to the WACC method. So we can conclude that the practical WACC formula is based on a set of often unrealistic assumptions, basically cash flow perpetuities, constant leverage ratio, unique and fixed corporate tax rate. APB is presented as a promising alternative method to get around WACC's limitations. In the next video, we will discuss under what circumstances each method is preferable, because WACC is indeed the best method under certain circumstances. So we will discuss in the next video, under what circumstances you should use WACC or you should use APB. And this is all I had to tell today.